On the 1st of June, an article in the Australian Financial Review speculated that negative interest rates are a chance of happening in Australia over the next 12 months, amid speculation that the Federal Reserve is poised to adopt them in the United States. What we'll see as we get into this analysis is that negative interest rates didn't happen in Europe because they were a good idea at the time. They came about because of a long period of political opposition to quantitative easing within the governing council of the European Central Bank. Since we've all been under house arrest, I've taken to watching a couple of webinars provided by esteemed American economists. One of these webinar series is provided by Stanford in Northern California. The other is provided by Princeton in New Jersey. It turns out that the chairman of the Federal Reserve, Jay Powell, graduated from Princeton in 1975. In a webinar on Friday, 29 May, he was interviewed by a previous vice chairman of the Federal Reserve, Alan Blinder. Blinder also graduated from Princeton, but in 1967. Some 20 minutes into the webinar, Blinder asked Powell, "Quite a few European central banks and Japan have pushed their overnight interest rates into negative territory quite a while ago and have kept them there. Yet the Fed, even before you were chair, has made it quite clear that it doesn't have any intention of doing that. Can you explain why? Is there some aspect of American exceptionalism that's not quite so obvious?" Powell replied, "We set a policy rate which is the Federal Reserve funds rate. We lower it, of course, when the economy is weak. We raise it when the economy is stronger. When inflation was more of a problem, we would often raise it. It hasn't been a problem for a while now. In the mid and late 1990s, Japan hit the effective lower bound. It hit zero. The question then came to the fore, well, what do we do now? Since then, it's been 20 years now, central bankers and economists have been working on the problem of what can banks do when they hit zero. Are they out of ammunition? And the answer is no. In the global financial crisis, the Fed got to zero, and we did two things. One, we effectively promised to hold our policy interest rate at zero for a long period of time. That affects short, medium, and long-term interest rates, and that supports economic activity because borrowers borrow all across the curve. We also bought, and this is what became known as quantitative easing, longer-term Treasury securities and other securities fully guaranteed by the US government in order to lower long-term yields. These are the two principal tools that we used during the financial crisis. We feel we understand them now. We no longer think of them as non-standard tools. We think of them as in the toolbox because we are in an era of much lower interest rates. We do expect to be part of the time at the effective lower bound of zero, which we are in fact right now. Some central banks decided that in addition to that, to use negative rates. We don't think that's an appropriate tool here in the United States, he said. He went on, I would say that the evidence on whether it actually works is mixed. There are clearly some negative side effects. It's not just clear to my colleagues and to me on the Open Market Committee that it's an appropriate tool to be deployed here in the United States. Blinder then asked Powell, well, what's the difference between here in the United States and the Eurozone? Powell went on, well, a couple of things. Firstly, I don't see the evidence. Whether it actually works, whether it actually helps is pretty ambiguous. One thing it does is it interferes with the process of credit intermediation. Banks take in deposits and they lend it out. To the extent that the policy rate is negative, you are crushing down on bank margins, and that makes them lend less. We also have institutional arrangements here that would not work with negative interest rates. Things like the money market fund industry, which companies of various kinds use to fund themselves and which individuals look upon as a place to put their money. We find there are two articles on the Federal Reserve website which support Jay Powell's view. These are published in the Finance and Economic Discussion series. The first paper was published in March 2017. It is called How Would US Banks Fare in a Negative Interest Rate Environment? The article is by David Arsenault. The author says, we find that banks that are more active in providing liquidity to borrowers anticipate suffering reduced probability through declines in interest rate income on short-term assets. A major job of the Federal Reserve is to ensure that banks provide enough liquidity to the market so they can function in times of crisis such as now. Negative interest rates reduce the profitability of banks providing short-term liquidity. Therefore, they damage the ability of the banking system to provide credit to the market in times like this. The second article was published in November 2019. The article is called Do Negative Interest Rates Explain the Low Profitability of European Banks? The article is by Nicholas Coleman and Viktor Stubanovs, a vaguely Russian name. They say numerous banks and bank analysts have expressed concerns about the detrimental effects of negative interest rates on bank profitability. After detailed examination of the profitability of European banks, they conclude that operating in a negative interest rate environment is associated with a reduction in the return on assets in the short run by a substantial and highly statistically significant 17 basis points, or roughly 30% of the average return on assets in 2018, which was the year they tested. When we put these two pieces of Fed research together, they tell us that firstly, negative interest rates damage the ability of the banking system to provide liquidity in a crisis. Secondly, negative interest rates damage the return on assets of the banking system even in normal times. This Fed research suggests that on both counts, negative interest rates are a bad idea. This asks the question, why does the European Central Bank in particular have negative interest rates? Our understanding is they got into the position of negative interest rates for historical reasons associated with the Governing Council of the European Central Bank. The Governing Council sets policy in the European Central Bank in the same way that the Federal Open Market Committee sets policy rates for the Fed. The difference is that the members of the Governing Council are finance ministers of different European nations with different political objectives. Negative interest rates for the ECB came about during a period of a long campaign of opposition to the use of quantitative easing at the European Central Bank. This campaign of opposition was led by the German Bundesbank and the Netherlands Central Bank. Interest rates had fallen below zero before either of these banks would agree to quantitative easing. After I looked at this, I found that even last month, on the 5th of May, there was a judgment by a German court that the quantitative easing of 2015 was against German law. So this battle goes on. Negative interest rates in Europe were allowed to happen essentially because of the dysfunction of the euro area political system. They were a bad idea whose time had come. The European Central Bank arrived at the point of negative interest rates through political dysfunction. They keep negative interest rates because, as usual, none of the parties involved in this mistake are prepared to take responsibility. In conclusion, research published by the Fed shows that negative interest rates damage the ability of the banking system to provide liquidity in times of crisis. They significantly damage the return on assets of banks even in a normal time. The chairman of the Federal Reserve says that the Federal Reserve is unlikely to ever move to negative interest rates. Nor do we think will the RBA. The Fed no longer thinks of quantitative easing and forward guidance as unconventional monetary policy. Both of them are thought of as being part of the toolbox the Fed will use as it moves forward. It will be forward guidance and quantitative easing that the Fed uses, not negative interest rates.